Okay, let's unpack this. Imagine a week where the NASDAQ composite, the very symbol of tech growth, innovation, it's hitting all-time highs, soaring.
Right. Uncharted territory.
But then, at that exact same moment, picture this palpable, almost dramatic rise in economic anxiety just rippling through the market.
How can both be true? It's a great question.
Exactly. How is that possible?
Sure.
This is the profound paradox we're really diving into today.
And it's an essential question because understanding that contradiction is, well, it's precisely our mission in this deep dive. We're going to examine the powerful, often opposing forces that shaped global financial markets for the week ending August 8, 2025.
Our goal here is to cut through the headline noise.
Yeah, right.
Dissect the underlying data.
Yeah, and help you understand this intricate inflection point so you can be truly well-informed, looking beyond just the flashy headlines.
And to do that, we've synthesized insights from, well, a comprehensive review. Market performance, key economic indicators, corporate earnings, significant geopolitical events from the past week.
Think of this as your express lane, maybe, your shortcut to really understanding the complex web of forces driving investor sentiment.
We've done the heavy lifting, connecting the dots so you don't have to wade through, countless reports yourself.
Hopefully.
So let's start right there with this unsettling contradiction because it really forms the core of everything that happened. On the surface, if you were just glancing at the headlines, U.S. equity indices actually posted solid weekly gains. The NASDAQ composite, like we said, didn't just gain, it set a brand new all-time high.
Incredible numbers. It closed at 21,451.97. That's a significant 3.88% weekly gain.
And the S&P 500, not to be outdone, smartly recovered from its prior week's losses. It was once again challenging its own record peak.
Finished the week at 6,392.40. That's a gain of about 2.48%.
Even the Dow Jones Industrial Average, often seen as the barometer for traditional industry.
Yeah, the old guard.
Right. It rose to 44,223.40, a respectable 1.46% weekly gain. So looking good on paper.
And that's exactly the deceptive part. Because beneath that apparent strength, there was this dramatic and palpable rise in underlying economic anxiety, risk aversion.
You could feel it.
You really could. This past week truly marked an inflection point where these abstract theoretical risks people had been talking about for months. Suddenly, they materialized.
It became concrete?
Yeah, concrete, quantifiable market drivers.
Yeah.
It created a genuinely treacherous landscape for investors, one where those seemingly positive numbers on the screen didn't fully reflect the deep-seated apprehension in the trading rooms.
Which brings us to a crucial question for you, our listener.
Right.
Why is it so important to look beyond just these top-line numbers?
Right.
How could a market that looks so healthy on the face of it actually be built on, well, maybe a fragile foundation? Because this week showed us it absolutely can be, like a house with a fresh coat of paint masking, some shaky foundations.
And that fragility was largely the product of two primary yet profoundly contradictory catalysts that drove this market divergence.
Okay, what were they?
The first was a significant and frankly sudden shift in monetary policy expectations. We saw a shockingly weak U.S. jobs report for July.
Shockingly weak is right.
It reported only 73,000 non-farm payrolls added. That fell significantly short of the 95,000 consensus forecast. That alone was enough to raise eyebrows, but it was only part of the story.
But the true gut punch of that jobs report, it came from the staggering downward revisions to prior month's job gain.
Oh, yeah. May and June. Revised lower by a combined 258,000 jobs.
258,000. To put that in perspective, that's the largest negative revision since May 2020, right in the thick of the pandemic lockdowns.
It's huge. This single adjustment fundamentally altered the entire labor market trend. It brought the 3-month average for job creation down to less than 40,000.
Less than 40,000. And that's way below the 80,000 to 100,000 jobs needed each month just to keep the unemployment rate from, creeping up.
It fundamentally changed the narrative around the strength of the U.S. economy overnight.
So the market reaction.
Swift and decisive, almost immediate. This report effectively cemented market expectations for a near-term Federal Reserve rate cut.
Okay.
It sent Treasury yields plunging. Bond traders immediately priced in a more dovish Fed stance, anticipating lower future interest rates.
And that helped stocks.
Well, it provided a powerful, if maybe somewhat tenuous, tailwind for equities. The probability of a September Fed rate cut, which had been, a contested possibility, maybe 40% before the report.
Yeah, people were debating it.
Right. It skyrocketed to a near certainty in traders' eyes, jumped to over 90% in its aftermath. It was a dramatic unilateral shift in sentiment, driven by just one unexpected data point.
So that's catalyst one, a suddenly dovish Fed, or at least a market that thinks the Fed's been forced into a dovish corner.
Exactly.
But what about the other major force you mentioned, tariffs? How did they really hit companies this week?
Right, the second force. Tariffs moved from this abstract macroeconomic discussion to a brutal reality for corporate balance sheets this week.
We saw it in the earnings calls.
Brutally demonstrated, devastating post-earnings collapses in companies like The Trade Desk and Under Armour. These weren't just abstract discussions about global supply chains anymore.
Yeah.
These companies explicitly cited tariffs as the direct cause for their weak forward guidance. It showcased the real-world consequences of ongoing trade disputes, made it undeniably clear that tariffs are no longer just, theoretical economic friction.
And the numbers really speak for themselves here. They provide a visceral demonstration of that impact. The trade desk plunged, what was it, a staggering 38.19% in a single session.
Historic drop.
Yeah.
And Under Armour fell 18.24%.
These weren't minor corrections. These were brutal, immediate repricings of entire companies because of tariff-related warnings coming directly from their own management teams.
It's a stark reminder of how quickly sentiment can turn when abstract policy becomes a concrete financial hit.
So these two powerful yet inherently contradictory forces a dovish Fed potentially easing conditions versus the concrete negative impact of tariffs on earnings.
Created this incredibly complex and, let's be honest, often bewildering market environment we saw this past week. The market was essentially being pulled in two very different directions at the same time.
And if you peel back another layer, beyond the headlines and even these big catalysts, there was this profound underlying defensive rotation happening.
Right beneath the surface.
Despite the broad index gains, a clear flight to safety was evident at the sector level. Non-cyclical utilities, often considered a safe haven because of their stable, regulated earnings.
Reliable dividends.
Exactly. They led the entire market, soared higher while economically sensitive sectors like materials and consumer discretionary stocks, they got battered.
And here's where it gets really interesting. This flight to safety happening at the same time as a rally in mega-cap tech stocks, which people often see as a risk-on signal.
Right, growth chasing.
It points to a low-quality, very narrowly led advance. It reveals a market that is deeply cautious beneath the surface, highly vulnerable to the next negative catalyst.
It tells us that while some investors were chasing performance in a very concentrated part of the market,
others were simultaneously reaching for perceived safety and capital preservation.
It's a classic indicator of underlying anxiety, isn't it? Despite what the headline numbers might suggest.
Absolutely. A real disconnect.
So if we sum up the key themes defining the week. First, the market's newfound conviction and a dovish pivot from the Fed, largely thanks to that stunning jobs report.
Check.
Second, tariffs moved from abstract risk to very real, tangible corporate impact, like we saw with those earnings disasters.
Check.
Third, escalating U.S.-India trade tensions emerged as a new geopolitical hotspot, a significant new development there.
Important one.
And finally, we saw strikingly divergent paths across global markets. Japan's ascent to new highs versus China's continued, stagnation.
Quite the contrast. It was a lot to take in, a true mosaic of conflicting signals.
Okay, let's zoom in on the U.S. equity market dynamics now, because they really presented this illusion of strength.
That's a good way to put it, illusion of strength.
The U.S. equity market embarked on a volatile roller coaster ride this past week, characterized by sharp swings, moments of hitting new record highs, and then unsettling reversals, all within days.
Ultimately, the major indices did close with solid weekly gains, but the journey itself underscored a deep-seated uncertainty among investors. It wasn't a confident, sustained march higher, not at all.
That's right. The week actually started strong. Stocks surged on Monday, recovering from that steep sell-off at the end of the prior week.
The initial rally was led by tech. Investors bought the dip in mega-cap names, maybe sensing a bargain.
This positive momentum carried into the middle of the week, and it was further fueled by genuinely powerful earnings reports from tech titans like Meta and Microsoft.
Right. Their strong results propelled their stocks to all-time highs and were enough to lift the S&P 500 to a fresh record peak, 6,389 on Thursday.
But, and this is a big but, this strength proved incredibly fleeting. Fragile.
Very fragile. On Thursday, right after touching that new all-time high, the S&P 500 reversed sharply, sold off throughout the session, closed near its lows.
And this price action created something technical traders call a bearish engulfing candle on the daily chart.
Yeah, can you explain that quickly?
Sure. It's basically when a day's price range, the body of the candlestick, completely engulfs the previous day's body. It opens higher than the prior close, makes a new high, but then closes lower than the prior day's open.
It's a classic technical pattern, often signals investor indecision, maybe potential downward moves.
It highlights that even as indices touched new records, conviction was incredibly thin. Sellers were quick to emerge, take profits, almost like the market was signaling its own exhaustion.
Let's break down the final close for the week using the numbers from Table 1 in our sources. The S&P 500 index finished the week at 6,392.40. That's a gain of about 2.5%, recovering all its prior week's losses.
The Dow Jones Industrial Average rose to 44,223.40 for a weekly gain of roughly 1.4%, but its performance was somewhat muted compared to the others.
Yeah, weighed down particularly by those tariff-sensitive industrial components like Caterpillar. They often serve as a proxy for global manufacturing health, so that lag is telling.
And the Nasdaq Composite, the undisputed leader we talked about,
Soared 3.9% to close at 21,451.97.
This tech-heavy index truly set a new all-time high during the week, powered by the continued strength of bellwethers like Apple, Nvidia, Microsoft.
Seen as beneficiaries of strong earnings, the ongoing AI-driven tech cycle.
Right. Even the Russell 2000 index, which tracks smaller companies and is often a better gauge of broader economic health.
It posted a solid weekly gain, too, around 2.5%, so that indicates some buying interest beyond just the mega cap.
But as we'll discuss, the concentration of gains was still very much evident, still implies a narrow market advance.
Now, for the deeper dive into this illusion of strength, one key piece of evidence was the behavior of the Cboe Volatility Index, the VIX, the market's fear gauge.
What did it do?
Well, on Friday of the previous week, as that jarring jobs report hit, the VIX surged 27%. Reached its highest level since late June.
27% jump in fear.
Yeah. And while it did recede by the end of this week, that sharp spike in expected volatility is inherently inconsistent with a confident, sustainable market rally.
What's truly fascinating here is that typically strong market advances are accompanied by falling volatility, right? Investors usually get more confident, less inclined to pay for portfolio insurance.
Exactly. So the fact that investors were pushing indices higher while simultaneously paying up for that insurance in the options market, effectively bracing for a potential downturn, signals deep underlying anxiety.
Its contradictory behavior points to a lack of genuine confidence in the rally's sustainability, almost like they were celebrating with one hand while clutching a fire extinguisher with the other.
That's a good analogy. Furthermore, the technical picture that emerged midweek was quite unsettling. That S&P 500 bearish engulfing candle on Thursday
Opened higher, new high, closed lower than the previous day's open.
Right. It's a classic sign of exhaustion. It indicates that the buying pressure driving the market to a new record was overwhelmed by selling pressure by the end of the day.
And such patterns often serve as a warning that the prevailing trend might be about to reverse, signaling the rally might be running out of steam.
So when you combine these factors, the rising VIX, despite index gains, the bearish technical signal, and the fact that most stocks weren't really participating, you start to see the picture.
That the market's advance wasn't broad-based, not high conviction.
Instead, it appears to have been driven by a mix of passive index investing flows, maybe a lot of short covering from traders who are betting against the market,
And a frantic chase for performance in just a handful of those mega-cap tech stocks.
and this narrow leadership makes the market highly susceptible to a correction if those few leading stocks begin to falter.
It's often described as generals leading while the troops retreat.
A condition that, historically, is incredibly unstable. When a market rally lacks broad participation, it tends to be less durable, more prone to sharp reversals.
It means that while the overall market cap seems okay, the average stock is struggling, like a few star players carrying the whole team.
So, this analysis helps you understand that strong headline numbers don't always tell the full story about market health. It's about looking beneath the hood, seeing what's truly driving the gains. And in this case, it was a very specific and perhaps fragile set of factors.
A critical distinction to make when you're assessing your own portfolio and thinking about future market moves.
Definitely.
Let's move on to sectoral shifts, because this is where the hidden signals really come to light. Provides a stark contrast to that headline optimism.
Yeah, the sector story is crucial.
While those major cap-weighted indices like the S&P 500 suggested a broad risk-on week, The actual performance of the 11 S&P 500 sectors told a starkly different story.
A story of profound investor caution, a clear rotation into defensive assets.
It directly contradicts the optimistic message of the headline index gains, doesn't it? Highlights the market's internal contradictions.
Indeed. If we look at Table 2, the week's winning sectors were those least tied to the economic cycle, signaling a clear flight to safety. Utilities, for instance, emerged as the top-performing sector.
Posting a strong gain of plus 1.5%.
Right.
And that's a classic flight to safety move. In times of heightened economic uncertainty, investors flock to utilities. They're often regulated monopolies, essential services like electricity, water.
Stable, predictable earnings streams, reliable dividends.
Exactly. Makes them attractive when growth is uncertain. Their outperformance this week is a loud signal. Market participants were prioritizing capital preservation over speculative growth.
And other defensive areas also held up much better. Communication services, which includes a mix of defensive telecom and some mega-cap growth.
Nearly flat at negative 0.1%.
And consumer staples, home to companies selling essential goods like food, household products.
Declined a modest 1.1%.
Both significantly outperformed the broader market's more economically sensitive components, underscores that cautious stance.
Conversely, the sectors that bore the brunt of the selling pressure were those most exposed to the global economic cycle and the direct impacts of trade policy.
The materials sector, week's worst performer by a wide margin, plunging minus 5.6%. Yeah. Reflects deep-seated fears about slowing global growth, which directly reduces demand for basic materials like metals, chemicals, and of course the immediate impact of tariffs on input costs for manufacturers.
And following closely behind materials were other cyclical sectors. Consumer discretionary down 4.5%, healthcare fell 3.8%, industrials dropped 3.4%, financials down 3.7%.
This broad-based weakness across cyclical sectors powerfully underscores investor anxiety. Fears about a potential slowdown in consumer spending, capital investment, lending activity.
All hallmarks of a weakening economy.
It's almost as if the market is speaking in two different languages right now, one of headline optimism, the other of underlying caution.
This stark divergence between the performance of the cap-weighted S&P 500 and that clear defensive rotation across most sectors, it represents a significant red flag for market health.
It suggests that market breadth, a measure of how many stocks are participating in a move, is exceptionally poor, and that the headline rally is incredibly fragile.
Exactly. The performance of the major indices this week was disproportionately influenced by a very small number of mega-cap tech stocks.
Apple, Microsoft, Nvidia. They command enormous weightings in both the NASDAQ and the S&P 500. They managed to post gains, effectively pulling the entire indices up with them.
But with 7 of the 11 S&P 500 sectors finishing down by more than 3%, it's clear the average stock had a difficult week, struggled to find buyers.
This phenomenon, as we mentioned, can truly be described as the generals leading while the troops retreat.
And historically, that's unstable.
Very unstable. A healthy, sustainable market advance is characterized by broad participation. Majority of sectors, stocks moving higher together. When a rally is carried by only a handful of the largest companies, it indicates a lack of broad-based conviction, makes it vulnerable to any shift in sentiment around those leaders.
This setup serves as a crucial forward-looking signal, suggests the market is highly vulnerable.
If those few mega-cap stocks that have been leading the charge were to falter, there's very little underlying support from other sectors to prevent a significant, maybe rapid market decline.
So if we connect this to the bigger picture, it means the market's effectively sending two contradictory signals at once. Major indices signal optimism. Underlying sectors signal pessimism, risk aversion.
This internal conflict increases the importance of closely monitoring the performance, the earnings reports, of those leading mega-cap tech names in the coming weeks. Their direction will likely determine the fate of the entire market.
Okay, let's shift to corporate earnings because this past week truly showcases stark divergence there too.
Yeah, dramatic company-specific moves. The second quarter earnings season wound down, and that real-world impact of U.S. trade policy became just undeniable.
Companies with strong execution, confident outlooks, handsomely rewarded.
But those caught in the crosshairs of tariffs or simply failing to meet lofty market expectations, severely punished. The market's reaction was swift and brutal for that latter group, showed an unforgiving environment for any misstep or unexpected headwind.
Let's talk gainers first, the power of strong execution. Gilead Sciences, for example.
Their shares jumped over 8%, delivered impressive Q2 results, raised full-year guidance, comfortably beat analyst estimates. Adjusted EPS 2.01 cents, revenue $7.08 billion.
Driven by a robust 7% increase in sales from their flagship HIV portfolio, including the key drug Biktarvy, showed fundamental business strength, cutting through the broader anxiety.
And then there was Expedia Group. Stock skyrocketed nearly 16%.
Huge move for Expedia.
Following a stellar earnings report that really assuaged growing fears of a broader consumer spending slowdown, especially in travel.
They beat expectations on all key metrics. EPS $4.24 versus $3.95 est. Revenue $3.79 billion versus $3.72 billion. Gross bookings up 5%.
Their B2B segment was a particular bright spot. Bookings jumped an impressive 17%. That's its 16th consecutive quarter of double-digit growth. And crucially, CEO Ariane Gorin noted a tangible uptick in overall travel demand, particularly in the U.S., since July, and raised full-year guidance, painted a more optimistic picture for the industry.
These decisive beat-and-raise reports were met with surges of buying pressure. In a market really starved for positive news, right? Stood in sharp contrast to the week's prevailing narrative of economic weakness.
Shows how much the market is looking for bright spots, rewarding companies that can deliver genuine, unblemished good news in an otherwise challenging environment.
But then we had the key losers, a tangible illustration of the brutal cost of tariffs and just failing to meet sky-high expectations.
The trade desk suffered a catastrophic historic decline, plunged a staggering 38.19% in a single session.
38%, even though they beat revenue expectations.
Yeah, but the stock was obliterated by a toxic combination. CEO Jeff Green issued a stark warning that new U.S. tariffs were having a very real negative effect on ad spending from its largest clients, compounded by an unexpected CFO transition, adding to investor uncertainty.
Perfect storm of bad news.
Exactly. And Under Armour experienced a similarly brutal sell-off. Shares fell 18.24%.
Their management explicitly and forcefully blamed U.S. trade policy for its woes, cited ongoing uncertainty around trade policies, direct cost impact of tariffs for its dismal forward guidance.
They shocked investors. Forecasted profitability would be about half of last year's, and Q revenue would decline by 6% to 7%. This was a company directly communicating the financial pain of policy decisions to the market. No mincing words.
And then there's Eli Lilly. Provided a different cautionary tale.
Right, not tariffs this time.
Suffered its worst trading day in 25 years, a decline of over 14%. The issue here, sky-high expectations.
Priced for perfection.
Exactly. Despite reporting a solid quarter, raising guidance, the market had priced in absolute perfection for its new obesity pill clinical trial data.
And when the data, though positive, failed to meet the most optimistic whisper numbers, those truly stratospheric expectations investors rush for the exits.
Demonstrates the danger of perfection being priced in. Leaves no room for anything less.
These cases are brutal studies. Show how quickly sentiment can turn when geopolitical risks translate into tangible business headwinds, or when perfection is simply priced into a stock.
And this leads us to a fascinating and frankly a bit unsettling development, the weaponization of earnings call.
Ah, yes, this was significant.
This past week revealed a significant evolution in corporate communication strategy. The explicit, direct, forceful attribution of weak guidance to U.S. tariff policy by the CEOs of the Trade Desk and Under Armour, that marked a very notable shift.
It moves the discussion of trade policy from, theoretical economics into the practical dollars and cents world of corporate profit and loss statements.
Right into the numbers.
These companies, in effect, weaponize their earnings calls, use them to send an unambiguous message to policymakers about the real-world economic damage their actions are causing. This contrasts sharply with the more cautious, generalized language about macroeconomic headwinds often used in the past.
It's a direct plea, or maybe a warning, to Washington.
The implications are significant. This transforms the quarterly earnings call from just a simple financial report into a high-stakes platform for corporate political signaling.
Potentially setting a powerful precedent for CEOs in other tariff-exposed industries.
This raises an important question. How does this change the landscape for investors and policymakers alike?
It could unleash a wave of negative corporate commentary directly targeting U.S. trade policy, adding another layer of complexity, potential market volatility during earnings season.
Forces investors now to consider not just the financials, but the political messaging coming directly from the C-suite. Imagine trading desks on these earnings call days, not just listening for revenue numbers, but for subtle or overt political statements. Adds a whole new dimension of risk to corporate analysis.
Definitely something to watch. Let's turn our attention now to the macroeconomic catalyst that fundamentally reshaped the week, that July jobs report.
The bombshell report.
It landed like a bombshell, didn't it? Alarmingly weak, shocking investors. It wasn't just a miss, it was a profound shift in the labor market narrative.
It truly was. Looking at Table 3, the headline miss itself was significant. U.S. economy added only 73,000 non-farm payrolls in July, far short of the 95,000 consensus, immediately signaled a cooling labor market.
But the most stunning aspect, the true revision shockwave.
Were those massive downward revisions to prior job gains? The figures for May and June revised lower by a combined 258,000 jobs.
And that's the largest negative revision we've seen since May 2020. This single adjustment fundamentally altered the underlying trend, brought the 3-month average job creation down to less than 40,000.
Well below the estimated 80,000 to 100,000 needed just to keep the unemployment rate from rising.
We also saw broader weakness. Unemployment rate ticked up to 4.2% from 4.1%. Labor force participation rate dropped to 62.2%. Indicates weakening on two fronts: fewer jobs, fewer people looking.
And other indicators like the ADP employment change, lower than expected at plus 104,000, and the June JOLTS report showing job openings falling to 7.44 million. They all corroborated this significant softness.
So the data was so unambiguously weak
that it effectively forced the Fed's hand, at least in the eyes of the market. The Fed's evolving stance shifted dramatically.
The week began with the market still digesting that late July Fed meeting, the one with 2 dissenting votes for an immediate 25 basis point rate cut.
Right. The first such dissent since 1993 signaled a growing divide within the committee itself. Initial commentary from officials was cautious. Atlanta Fed President Bostic said as late as Thursday it was too soon to commit to interest rate cuts.
But the Friday jobs report rendered all that caution moot.
Completely moot. The market-implied probability of a 25 basis point cut at the FOMC's next meeting in September skyrocketed, from around 40% before the report to over 90% afterwards.
A unilateral repricing of Fed expectations. Almost a dare to the central bank.
And the bond market reacted violently. The 2-year Treasury yield, highly sensitive to Fed policy, plunged 18 basis points on the week, reflecting that sudden certainty of lower rates.
So the market is no longer debating if the Fed will cut rates.
No, it's now fully priced for easing to begin in September, which brings us to a crucial point: the Fed's credibility trap.
Explain that.
The Federal Reserve now finds itself ensnared in this credibility trap, largely of its own construction, by repeatedly, emphatically signaling a data-dependent approach.
They tied their own hands.
Effectively, yes. The catastrophic July jobs report was such a clear, decisive piece of negative data that it has cornered the Fed into validating the market's aggressive pricing for a September rate cut.
This creates a truly perilous dilemma, doesn't it? No easy exit.
None at all. On one hand, if the Fed were to defy market expectations and not cut rates in September, it would risk triggering a severe market tantrum.
Fed blindsides market. Headlines everywhere.
Exactly, seen as a direct contradiction of its own data-dependent framework, leading to questions about its reaction function, increased uncertainty, potential sell-off in risk assets.
Okay, so what's the other hand?
If the Fed does cut rates, as the market now fully expects, it faces other significant risks. Proceeding with a cut when its preferred inflation gauge, core PCE, remains elevated at 2.8%, still well above its 2% target, is a huge policy challenge.
To be seen as capitulation on fighting inflation.
Precisely. Could signal the central bank is more concerned with short-term growth scares than its long-term price stability goal. Could risk unanchoring inflation expectations. Furthermore, it would validate the concept of the Fed put.
The idea the Fed will always bail out the market.
Right. Reinforcing the belief that one bad data report forces the Fed to ease policy, potentially fueling excessive risk-taking moral hazard down the line.
So what does this all mean for the economy and your investments?
There's no simple path forward. The Fed's attempt to maintain flexibility has, in many ways, been undone by one report. Upcoming communications from Fed officials, and most importantly, the next round of inflation data. They'll be scrutinized with intense focus because of this high-stakes predicament.
Caught between a rock and a hard place. Classic. Now, let's turn to the global stage. Geopolitics and trade policy created a dramatically shifting landscape this past week.
Yes, particularly the escalation in U.S.-India tariffs created a new geopolitical fault line.
This was driven by President Trump's executive order imposing an additional 25% tariff on all goods imported from India.
Brings the total tariff rate on Indian goods to a punitive 50%, among the steepest ever imposed by the U.S. on a major trading partner.
And crucially, the justification wasn't typical trade stuff.
No. The White House didn't frame it as a typical trade dispute over market access or unfair practices.
Mhm.
Instead, it explicitly linked the tariff to national security concerns, citing India's abject refusal to stop buying Russian oil as the primary justification.
That's a direct, unambiguous use of economic leverage to enforce U.S. foreign policy objectives related to the war in Ukraine.
By targeting India, a major developing economy, a democratic ally, the administration is signaling that access to the U.S. market is conditional on alignment with its geopolitical priorities, impacts relations far beyond just trade.
And the market reaction in India, immediate and severe, sent Indian equity markets into a corrective phase. The Nifty 50 index saw high volatility, its sixth consecutive weekly loss.
There were even reports, later denied by India's defense ministry, that New Delhi paused negotiations on new U.S. arms purchases in retaliation. Indian officials publicly called the hike illogical. This isn't just about tariffs, it's geopolitics playing out in real time.
And this U.S.-India friction didn't happen in a vacuum, right?
No, it's the latest, most acute manifestation of an aggressive, unpredictable global trade posture, a persistent headwind for the global economy.
All happening against other high-stakes situations, like the fragile U.S.-China trade truce set to expire August 12th. Ongoing negotiations there.
Could still swing either way. And the administration's approach has been notably divergent punitive rates on India, Brazil, 50%, Mexico, 30%, versus more conventional 15% with the EU, Japan.
Adds another layer of complexity, unpredictability for global businesses trying to navigate this landscape. Forces them to consider political alignment more than ever.
And this punitive action against India represents a significant, potentially damaging challenge to the prevailing friendshoring or ally-shoring doctrine.
Explain that connection.
Well, that strategy aimed to de-risk U.S. supply chains by moving them from rivals, like China, to trusted partners like India, Vietnam, Mexico, based on political and economic alignment.
But imposing debilitating tariffs on a key strategic partner over a separate foreign policy disagreement
Sends a powerful disruptive signal. Economic partnership is conditional, can be summarily revoked if a country's foreign policy isn't in lockstep with the U.S. It fundamentally undermines the core premise of friendshoring, makes the friend part far more ambiguous, fragile.
And the logical implication for a multinational corporation is unsettling. Why invest billions years of effort to relocate a complex supply chain from China to India, a move encouraged by friendshoring policies, if India itself could become a target?
Due to shifting geopolitical winds or disagreements on unrelated issues.
Exactly. It injects a high degree of political risk into long-term investment decisions. Could lead to greater supply chain fragmentation, reluctance to make large-scale foreign direct investments, ultimately higher costs for businesses, consumers.
Could chill the very investment trend the friendshoring policy was designed to encourage. It implies no trading relationship is truly secure from political intervention, even among allies. Could significantly reshape global commerce.
Let's take a quick look at international markets now. Because the cross-currents of U.S. data, shifting central bank expectations and trade tensions, produced a highly fragmented, divergent performance across major international markets.
Truly a tale of two continents, Europe showing cautious resilience, Asia embarking on starkly different paths.
In Europe, looking at Table 4, markets managed to navigate the week's volatility, post modest gains, though sentiment remained fragile. UK's FTSE 100 ended slightly higher.
At 9,095.73, gaining about 0.3%. Supported by the Bank of England's decision to cut its policy rate 25 basis points to 4.0%. Widely expected move.
And the resulting weaker British pound provided an accounting boost to the many multinationals in the FTSE 100 earning revenue in foreign currencies.
Makes those earnings worth more when converted back to pounds.
Germany's DAX index was a strong performer, gained over 3% for the week, closed around 24,193.
Underpinned by broadly positive Q2 corporate earnings from banking, pharma, auto sectors, signaled some resilience in key German industries.
But gains were capped by lingering caution over U.S. tariffs and a sharp 7% drop in Munich Re shares after it cut its 2025 revenue forecast, reminded investors of those persistent global headwinds.
But the performance gap in Asia was the most dramatic story. Highlights how regional factors, specific policy developments lead to vastly different outcomes.
Japan's Nikkei 225 was the standout global performer.
Absolutely surged. Posted a remarkable 1.9% gain on Friday alone. Closed at 41,820.48. Gained about 3.8% for the week. Puts Japan on a remarkable trajectory, continuing its multi-month climb.
What drove the rally in Japan?
A powerful combination of positive catalysts, strong corporate earnings from heavyweights like SoftBank, Sony Group, a consistently weak Japanese yen against the US dollar.
Helps their exporters like Toyota, Honda, makes goods cheaper, more competitive abroad.
Right. And growing expectations that Japan, having recently negotiated a trade deal with the US, would be spared from harsher tariff actions hitting other nations, reduced a major source of uncertainty for their economy.
But in stark contrast, China.
Chinese markets languished under the weight of both domestic economic weakness and external trade pressures. The Shanghai Composite was largely flat for the week, closing around 3,635. Investors weighed hopes for a U.S. trade deal against ongoing economic concerns.
And Hong Kong.
The Hang Seng Index surrendered all of the previous week's gains, dropped about 3.5% to 24,858.82. These markets were pressured by a confluence of negative factors.
Like what?
Disappointing cakes and services PMI pointing to contraction in the crucial services sector, currency interventions by the Hong Kong Monetary Authority to defend the HK dollar peg, and persistent fears over the future of the U.S.-China trade relationship ahead of that August 12 truce deadline.
A clear demonstration of how localized economic issues, geopolitical uncertainty, can severely impact market performance, even as other global markets thrive. All right, let's look ahead now. Because the market enters the new week, the week of August 11th, precariously positioned.
That's the word. Precarious.
The prior week's trading was driven by that singular, powerful narrative. The weak jobs report effectively gave the Fed a clear green light to cut rates in September.
That assumption is now the newly adopted consensus, deeply etched in asset prices, investor expectations.
And this upcoming week will serve as a critical test of that consensus. The focus shifts squarely from employment to inflation.
And the incoming data will determine whether the market's dovish green light stays on or if it's about to turn red.
The economic calendar, Table 5, is packed with high-impact data releases, potential to spark significant market volatility, especially given how narrowly focused the market has become.
The undisputed main event, U.S. Consumer Price Index, CPI, for July, scheduled for 8:40 a.m. ET on Tuesday, August 12th.
This will be the market's first, most important look at inflation after that weak jobs report. A hotter-than-expected number could throw cold water on rate cut expectations.
While a soft print would powerfully validate the market's dovish stance, could fuel further rallies.
The inflation picture gets further clarity from the Producer Price Index, PPI, due out 8:30 a.m. ET, Thursday, August 14th.
Right, measures inflation at the wholesale level, can be a leading indicator for future consumer prices, as producer costs often get passed on.
And on Friday, August 15, investors will parse reports on the health of the U.S. consumer, retail sales for July, preliminary University of Michigan consumer sentiment for August, crucial insights into consumer spending.
Major driver of the U.S. economy. Internationally, key growth data also on the docket. Q2 GDP figures due from the U.K. and Japan on Thursday.
And while the peak of Q2 earnings season has passed, still some important companies reporting.
Key names to watch. Networking giant Cisco Systems on Wednesday, industrial bellwether Deere & Co. on Friday.
Their results, and more importantly, their forward guidance on enterprise spending, the agricultural economy, will be closely scrutinized for broader economic signals, especially given those tariff concerns.
But the upcoming CPI report, it's far more than just another data point. It represents the moment of truth for the market's entire post-jobs report narrative.
The market moves swiftly, unilaterally to one conclusion. Slowing growth trumps persistent inflation, giving the Fed a clear mandate to ease in September.
That assumption is now deeply embedded in asset prices, from equity valuations to treasury yields, effectively locking in market expectations.
And this creates a starkly binary risk scenario. It will either validate or invalidate this consensus.
If we get a hot CPI print showing inflation isn't just sticky but maybe re-accelerating, it would directly challenge the market's narrative.
Puts the Fed in that impossible position again. Cut rates into rising inflation, sacrifice credibility, or hold steady, defy market expectations, risk a sell-off.
Such an outcome could force a rapid, painful unwinding of those dovish trades put on with such conviction last week. Likely sharp spike in treasury yields, corresponding drop in equities, a brutal adjustment.
Conversely, a soft CPI print
would be a powerful validation of the market's view. Confirm inflationary pressures are easing alongside economic growth. Provide the Fed the clean justification it needs to cut rates.
Could ignite a powerful risk-on rally. Confirming the best of both worlds scenario investors are positioned for. Slowing growth warranting easing without the stagflationary complication of high inflation.
The stakes for the single data release have rarely been higher. The market has constructed this fragile, single-threaded narrative. It's now positioned for a significant move.
And the direction of that move will almost certainly be determined by the inflation data Tuesday morning. Highlights the immense influence of a single data point, why understanding its implications is crucial, especially when so much is riding on it.
So we've unpacked a truly paradoxical week. Headline gains despite deep-seated anxiety. Saw how a weak jobs report pushed the Fed towards potential cuts, while tariffs delivered a tangible immediate blow to corporate profits.
And how sectors revealed that cautious flight to safety beneath the surface. We also explored the new, politically charged landscape of earnings calls and the stresses on global trade policies.
So what does this all mean for how we understand risk and opportunity today?
Consider how the increasing politicization of corporate communication and global trade policy might fundamentally reshape how investors analyze risk. Seems we're moving beyond just traditional economic indicators.
To explicitly factor in geopolitical alignment, even CEO rhetoric.
What does it mean for the future of global supply chains, international investment, if political considerations start to consistently outweigh economic efficiency?
Indeed. We've given you a lot to mull over. Take these insights, reflect on how you might apply this deeper understanding to the information you encounter daily.
How will you navigate a market where policy decisions and corporate statements are increasingly intertwined, shaping the very fabric of global commerce? We'll be here to keep diving deep with you.